Hello there everyone, hot off the press, my thoughts on the budget today, Wednesday 26th of November 2025. Lots to go through. I'm just going to rattle off each one of these. I'll do separate videos that can enhancing quite a few of these things, but here we go. Freezing of the tax thresholds for an extra 3 years to 2031. It had already been announced that these thresholds will be fixed till 2028, so more and more people will be dragged into paying high rate tax, so-called fiscal drag. Of course, there's a general election 2029, so whoever gets in, if it's not the current lot, may well reverse it. But that is the single biggest revenue raising measure announced today. Extra 3 years of freezing the thresholds. Mansion tax. Properties over 2 million. This is in addition to council tax. It's a surcharge. So on top of an existing, whatever the council tax you're paying on these properties, 2,500 it's going to start at, £2,500, going up to 7,500 kicks in for those properties that are worth in excess of 2 million. EOT, selling your business to an employee ownership trust. That's been in for about 10 years. Gained a lot of traction in more recent years. Costs the Exchequer a lot more than they originally thought it would do, so they've curtailed the tax relief on that. So when you sell your business to an EOT, you don't get 100% capital gains tax relief. That will be, you'll get 50% of the sales proceeds at zero tax and the rest at the capital gains tax rates. Salary sacrifice into a pension become a lot more popular in recent years, where you say to your employer, pay me less salary and instead put a bigger chunk into my pension. That saves on national insurance. The government have said, look, we don't like that. It was costing too much money, so we're going to curtail it to £2,000. The amount you can salary sacrifice and get that NI reduction, £2,000. What's next? Tax on miles driven on electric cars. Petrol, diesel cars pay vehicle excise duty. Nothing similar for electric cars. The government say, look, that's not fair. We need people who drive electric cars to chip in. How exactly they're going to do it, they don't know yet. All they've said in the red book in the Treasury document is we respect privacy. We're not going to sort of say to you, where have you been? We want to know number of miles. It's almost like a self-assessment thing. Devil's in the detail. Detail hasn't been announced, but that is kicking in from April 2028, taxing electric cars on how many miles you drive. Right, what have we got here? Confirmation of the triple lock. So good news for the pensioners. The government have said they will keep the triple lock. A lot of speculation that would go. That is going to stay. Business asset disposal relief. Again, if you sell your business, let's say it's not to an employee ownership trust, but it's to a third party buyer, say, then you would pay capital gains tax. There's none of this 0%, but it is a lower rate of tax. Currently, it is 14% on the first million. That 14% will go to 18% from April 2026. Incorporation relief, capital gains tax. For decades, if you were a sole trader and you incorporated your sole trader business, there were reliefs for CGT for that to apply. That transaction was automatic, that the reliefs would apply. It has been like that for decades. Now you're going to have to separately claim that relief. So they're not taking it away. It's just basically a bit more admin for claiming the incorporation the incorporation relief on CGT. Right. Here's one, buried in the detail of the Red Book. It's going to affect potentially every owner-managed business, every SME in the UK. Separate, extra reporting on payments to participators. What does that mean? Well, you got your own limited company. How are you going to pay yourself from your company? Well, you got salary, you got dividends, you've got director's loan. And there's mechanisms for reporting all of those already on tax returns. You put your salary on, your dividend, your DLA if it's more than 9 months after the year end and you need to pay a separate tax charge. But the point is, the government obviously thinking they're not getting enough information and not enough real-time information on how director shareholders of limited companies, small companies, are paying themselves. So watch out for this. Could be more reporting requirements where you've got to give them more information than what they're currently getting on tax returns. All right, so Treasury Red Book says we want to basically tax people with a bit of wealth more. It says that in black and white. 3 ways they're going to go after people with a bit of cash: property, dividends, and savings. So, from April 2027, call it a surcharge. It is a surcharge. It's extra tax that is already being put on if you are a landlord. So, you've got rental profits and you're paying income tax. They get added on with your other income sources, your employment, whatever it is. If it's basic rates, you pay 20%. If it's higher rate, you pay 40%. If you're in the additional rate, you pay 45%. 2% surcharge kicking in from April 27. So just looking at your property in isolation, your property profits, you'll pay 22%, 42% and 47% respectively. So basically an extra 2% on what you would have paid before that change. So dividend tax. Now this is going to affect thousands and thousands of entrepreneurs, SME owners, managers, directors, shareholders, got their own company, you're paying yourself dividend. Often many people will do the minimal salary, maximum dividend route, bit of salary to get your NI credit for state pension, topped up with dividend. And if you're keeping that in the basic rate band, which a lot of people are, got a husband and wife say they can get up to 50 grand out of their company, combination of salary and dividend, very low rates of tax. Low because the dividend tax, 8.75% of the basic rate. But again, it's going to be hit for this another 2% surcharge like with the property tax. So that dividend rate will go from 8.75 to 10.75. Higher rate, 33.75 to 35.75 if you are paying yourself higher rates of dividends. So when they said on the headlines on the budget when the Chancellor stood up and she said we're not going to raise income tax or VAT, excuse me, yes, you're increasing income tax right here. Increasing income tax for landlords, for business owners, for every small company in Britain, increasing income tax on those increased taxes on dividends that everyone pays themselves from their own company. And thirdly, savings tax. Again, it's another 2%. They've decided to hit 2% on each of these three. 2% on the taxable bands for savings. And that kicks in, I think that kicks in next year. And remember, there are tax-free slices of savings income. If you're earning, depending on what your earnings are, your other earnings, you can have a nil rate band of savings income. But when it's subject to tax, put another 2% on whatever band that you're in. All right, so what else? Capital allowances. Now, often plant and machinery, you're buying some computers, for some equipment for your business, you get 100% tax write-off. Certain things don't get 100% tax write-off and you get 18%. It's quite prescriptive, 18% 1 year, then 18% on 82%, 18% on 64%, and so on. That 18% is going to drop to 14%, so less generous. This is for things like hybrid cars. So you're going to be able to get tax relief over a longer period. So not as good as it was. What have we got? VCT relief, venture capital trusts. Quite a popular investment for higher rate taxpayers. You can knock a few quid off your income tax bill by investing in certain things. What the government has said is that actually you can put more into VCTs and EIS. So that in terms of that, it used to be capped, and it still is, but the cap's gone up. But the quid pro quo is that the actual tax relief itself for VCTs is going to come down from 30% down to 20%. All right, cash ISA. The amount that you can put into an ISA, a cash ISA, has dropped from 20 grand a year to 12,000 a year for the under 65s. So I'm glad that they've put that stipulation in because a lot of older people like having money in cash ISAs. They don't want to invest it on the stock market when you get to that age. They want it nice and safe, earning a decent rate of interest. Cash ISAs, perfect. So the government has said, yes, but you can get the economy going a lot better by investing on the stock exchange. Great. But if you're of a certain age, no, that ain't great. So thankfully, they've said, look, we're going to caveat the new rule. That reduction, 12,000 a year in cash-only ISAs, applies just to the people below the age of 65. The ISA limit stays at 20,000 if you're doing your stocks and shares ISA. So what's next? Another one in the small print that could have big ramifications for businesses, just like this extra reporting of how you are paying yourself from your own company. E-invoicing. The government will make it mandatory for all businesses to send electronic invoices to other businesses and to customers, B2B and B2C, from 2029. Consultation to start next year. So what is all that about? So starting with the digital theme of making tax digital a decade or so ago, now it's coming on to invoicing. But what kind of invoicing? Is there going to be some sort of central area where all these invoices are that somehow the government are going to see these? I mean, that's going to be, talk about big data, but why? What's the rationale for the government wanting to see, if they need to, everything electronic invoices? Now, I would suggest a lot of people anyway do send out invoices electronically anyway, but obviously there's still a lot of people who do paper invoices. But why the government is going to make this mandatory from 2029, e-invoicing? All right, so that's quite a big deal. So watch this space because it's going to apply to every business in the land. And finally, EMI, enterprise management incentives. It's a good thing. It's a tax break to encourage businesses to retain talent, and that has been expanded to apply to not only startups but also to scale-ups. So that's a good thing. So there you go. Hot off the press, me going through the Red Book, seeing a lot of what was in there, bringing that to your attention. Like I said, I'll do separate videos, I'm sure, on some of these. But yeah, just an overview there on today's budget. If you like this video, please do subscribe. And as always, I'll see you soon.